Let's start with the profitability ratios. These ratios analyze the ability of the entity to generate income, control expenses, and generate profit. All right, guys, now I'm not just going to read through all of the ratio calculations with you. I want you to jump to lecture example 1. And we are going to work through this lecture example, and whilst working through this lecture example, I'm going to show you how to apply all of the information provided in the lecture notes. So in this example, we are given information relating to Camille Limited for the year ended 31 December 20x6. First, we have the statement of profit or loss and other comprehensive income for the year ended 31 December 20x6. So on this statement, we've got revenue, cost of sales, gross profit, other operating expenses, operating profit, other income, finance costs, profit before tax, income tax expense, and profit for the year. In the additional information, you are told Camille Limited has 100,000 shares in issue. During the 20x6 financial year, the marketing director launched a national marketing campaign in an effort to boost sales. So guys, this is a potential reason. If we perform our calculations and we see that there's been an increase in sales, this would be the reason for the increase in sales. Camille Limited decided to change suppliers in 20x6 due to poor service delivery from the existing suppliers. So this might also have an impact on some of our ratio calculations and could also be potentially used as a reason. Three new admin assistants were appointed in 20x6. Once again, this would also impact on the costs of the company. If they hire new people, you would expect salaries to increase. So this could also be used as a potential reason when we get to our ratio calculations. The current rate of inflation is 5%, and the following industry averages are available. So we've been given the change in revenue, gross profit margin, operating profit margin, net profit margin, and the change in earnings per share. Then in the required, you need to calculate and comment on the profitability ratios relating to Camille Limited. All right, guys, so firstly, you can see we are going to have to perform calculations. After performing the calculations, we are then going to comment on all of those calculations. And you can see you are not told what calculations to perform. The required simply says calculate and comment on the profitability ratios relating to Camille Limited. So you need to know which ratios fall under the heading profitability ratios. All right, so based on the information we've been provided with in this example, let's go back to the lecture notes and see what we've been given in the lecture notes. So first, when it comes to profitability ratios, you can calculate changes or movements. And whenever you calculate a change or a movement, you take the current year amount, you deduct the prior year, and you divide by the prior year. That's how we calculate a movement. And you can calculate movements in various different things. You can see I've included all of the possibilities below. However, it's very important. You need to let the information provided in the question guide you. That will help you in terms of what calculations you can perform and what calculations you can't perform. So first, in our example, we can definitely calculate the change in revenue because we were given revenue for the current year and also the prior year. We can also calculate the change in cost of sales. We have the available information. We can calculate the change in gross profit. We can also calculate the change in operating costs. We can calculate the change in operating profit. Now, I just want you to go back to the example. If you look at the layout of the statements of comprehensive income, we were given operating profit over here. So we are going to calculate the change in operating profit, the movement from last year to this year. Please note, as an alternative, you can also calculate the change in EBIT or the change in EBITDA. But just let the format of the statement of comprehensive income guide you, and then you'll know which calculations to perform. If they've shown EBIT on the face of the statement of comprehensive income, then rather calculate the movement in EBIT. If they've disclosed EBITDA, then rather calculate the movement in EBITDA. So guys, it's important that you let the information provided in the question guide you, and also let the layout of the statement of comprehensive income guide you. Then you'll know which calculations to perform. We can also calculate the change in other income because that was given to us, and we can also calculate the change in net profit. So all of those calculations can be performed. Then please just note over here, when it comes to your discussion and when you are benchmarking, you can benchmark changes in revenue and costs to the inflation rate. So if the inflation rate is provided in the question, you can use this as a benchmark when you are looking at the movement in revenue and also the movement in your costs. But mostly, you'll see we look at this, or we link this to the movement in revenue. And I'll discuss that in more detail when we get to our calculation in our example. All right, then please note, guys, also, you can see the next ratio calculation that we have over here is operating cost as a percentage of revenue. So this is where you take the operating cost and you divide by revenue. Please note that this calculation is an alternative to calculating the movement above. So just above you can see, you can calculate the change or the movement in operating costs. So instead of calculating the movement in operating costs from last year to this year as an alternative, you can take those costs and you can express them as a percentage of revenue. That's just another way to look at the calculation. However, guys, please note that both of these calculations are going to provide you with exactly the same information for discussion purposes. So don't waste time performing both calculations. Either calculate the movement in operating costs or calculate the operating cost as a percentage of revenue. And then one other thing before we go back to our lecture example, you'll see here when calculating the change in operating costs, if you have sufficient detail, this calculation should be performed for each type of major operating expense. So if you're given the breakdown of what operating costs are made up of, so for example, they might tell you that included in operating costs, you've got salaries and wages, you've got sales and distribution costs, you've got marketing costs, you've got depreciation, etc., water, electricity, etc. They might give you the breakdown of what operating costs are made up of. If that breakdown is provided, then you should perform this calculation for each major operating expense. So don't just analyze operating costs in total by calculating the movement in total. You should calculate the movement in each major expense. So if salaries and wages is a significant expense, you should calculate the movements in salaries and wages. And exactly the same logic applies if you are performing this alternative calculation where you express the cost as a percentage of revenue. Once again, if you have sufficient detail and you know what the operating costs are made up of, for each type of major operating expense, you should perform this calculation. So for example, once again, if salaries and wages is a significant expense, then you should take the salary and wage cost and divide by revenue so that you can express that cost as a percentage of revenue. All right. And you'll see also the same logic applies to other income. If you're calculating the change in other income and you have sufficient detail, so in other words, they tell you what other income is made up of, you should then calculate the change for each type of major other income. So exactly the same logic applies. Now, if we go back to our lecture example, guys, we don't know what the other operating expenses are made up of. So in this example, we are just going to calculate either the movement in operating expenses or operating expenses as a percentage of revenue, but we won't be able to look at it in further detail because we don't know what's included in operating expenses, and the same applies to other income. We actually don't know what's sitting in that amount. So we can only perform the calculation in total, using the total other income amount. we don't actually know what that relates to. All right, so guys, let's first look at all of the movement calculations. They're very simple calculations. So here's the change or the movement in revenue. Now I'm just going to mark these off to make sure that we cover everything in this question, but I'm not going to waste your time actually looking at the numbers here, guys. This is very simple. So if you need to, pause the recording, make sure you're happy with all of the calculations, but all of these movements are very simple calculations. You are taking the current year revenue, you are subtracting the prior year revenue, and you are dividing by the prior year. All right, very simple, so I don't want to waste too much time on that. So first we look at the change in revenue. Then we look at the change in cost of sales. So just go down the statement of comprehensive income. Then we look at the change in gross profit. We then look at the change in operating expenses, or as an alternative, you can calculate operating costs as a percentage of revenue. And once again, you can see here I've said there's insufficient information to analyze this expense in more detail. We don't know what that cost is made up of, so we can only calculate the movement in total or the cost as a percentage of revenue in total. We then calculate the change or the movement in operating profit, the change or the movement in other income, and the change or the movement in net profit. All right, so that deals with all of the changes or movements that can be calculated in this example, and make sure all the time you always let the information provided in the question guide you. Then you know which calculations should be performed. We can then calculate various different types of margins. And guys, when you calculate a margin, you are always dividing by revenue. So if you are calculating the gross profit margin, you take gross profit and you divide by revenue. If you are calculating the operating profit margin, you take operating profit and you divide by revenue. Okay, etc. You get the point. Very simple calculations. You are always dividing by revenue. When it comes to margins, you can calculate a gross profit margin, an operating profit margin, an EBIT margin, an EBITDA margin, and also a net profit margin. Once again, guys, you let the information provided in the question guide you. In this example, we did not have EBIT or EBITDA, so we are going to focus on the operating profit margin because that was disclosed on the face of the statement of comprehensive income. All right. So in this example, we can calculate gross profit margin, we can calculate the operating profit margin, and we can also calculate the net profit margin. So let's just mark off those calculations quickly. Okay, so there's our gross profit margin. There's the operating profit margin. And there's the net profit margin. Then please note, when calculating the net profit margin, net profit is influenced by various different things. If companies have different accounting policies, that will affect their net profit. And if they have different capital structures, that will also affect their net profit. Because if you have a company that has a lot of debt in their capital structure, they will have higher finance costs, and that will obviously have a negative impact on net profit. So guys, it's important to note that the net profit margin is a poor financial indicator when making comparisons. So it's not a good idea to calculate the net profit margin for our company and then compare that to similar companies in the same industry, because all companies have different accounting policies and all companies have different capital structures. So it's preferable to rather use the EBITDA margin when making comparisons. And the reason for that, guys, is EBITDA is earnings before interest, tax, depreciation, and amortization. So if it's before interest, that means differences in capital structures will be eliminated. And if it's before depreciation and amortization, then things like differences in accounting policies will also be eliminated. So if companies have different accounting policies when it comes to depreciating their assets, obviously if you are using earnings before depreciation, then that difference is eliminated. So it's preferable to rather use the EBITDA margin in your calculations instead of the net profit margin. If you do calculate the net profit margin, just remember to state this limitation over here. Then the next profitability ratio that you need to be able to calculate is operating cash flow to operating profit. And you can see I have included the interpretation for you over here. So this ratio indicates the entity's ability to convert their operating profit into cash. And if you look at the formula just below, you take net cash flows from operating activities, so that would come from the statement of cash flows, and you divide by operating profit. So guys, we are looking at the entity's ability to convert their operating profit into cash flows. So you can see that just above in your interpretation. So guys, if you are struggling with the interpretation, look at what goes into the calculation. Look at the formula. The formula gives you the interpretation. We are looking at the entity's ability to convert their operating profit into cash flows. And the reason why this formula is important, remember guys, we don't just want the company selling on credit to a lot of debtors, but then they can't actually collect the money from the debtor. Because remember, if the company has very easy credit terms and they sell a lot on credit, obviously their sales will be higher and the operating profit will be higher. But if we then compare this to the cash that they generate from their operating activities, we'll pick up if there's a problem. Because that's fine. You should try and improve profits. However, that mustn't be to the detriment of the cash flow position of the company. They need to still be able to collect the money from their debtors. So we are looking at the ability of the company to convert the operating profit into cash. So please make sure that you can perform this calculation and make sure that you can interpret the calculation when it comes to discussion. Please note, guys, we can't perform this ratio calculation in our lecture example because we don't have the net cash flows from operating activities and we don't have the statement of cash flows. So we can't perform this calculation. But if you do have that information, you should perform this calculation under the heading profitability. Then the next ratio that you need to be able to calculate is the degree of operating leverage. And once again, I've got the interpretation for you over here. This ratio indicates the degree to which the entity's costs are fixed. And the reason why it's important to know the degree to which the entity's costs are fixed is if a company has very high fixed costs, they are going to have a higher break-even point because they will need to sell more in order to cover those fixed costs. So that's why this calculation is important. How do you calculate the degree of operating leverage? You take sales less variable costs, so that would be contribution, and you divide by operating profit. If you get a high answer over here, that means that the company has a high operating leverage, and it means they have high fixed costs. And the impact of having high fixed costs means that your break-even point is going to be higher because you need to sell more in order to cover those fixed costs. All right, now once again, guys, we can't perform this calculation for our lecture example because we don't know what portion of the costs are fixed costs and what portion of the costs are variable costs. We've been given total cost of sales, we've been given total operating expenses. We don't know what portion is fixed and what portion is variable. So we can't perform this calculation for our example. However, if you can perform this calculation, you should perform this calculation under the heading profitability. Please then make sure that you are able to interpret the calculation and discuss the impact of having very high fixed costs. So if a company has a high degree of operating leverage, they have high fixed costs, and their break-even point will be higher because they need to sell more to cover those fixed costs. Then the next calculation that we are going to look at is the effective interest rate. And you calculate the effective interest rate by taking total finance costs from the statement of comprehensive income and dividing by total interest-bearing debt at the end of the previous period. So let's just discuss this in a bit more detail to make sure that you're happy with the logic behind this calculation. Let's draw up a timeline here quickly. Let's say that this company has an outstanding loan amount of 100,000 Rand at the beginning of the year, and at the end of the year they make a payment of 20,000 Rand, so then there's only 80,000 outstanding on the loan. All right, very simple calculation, but it's just so that you understand the logic behind what we're doing over here. All right, now, if you have to calculate interest, the interest expense or the finance costs that are payable in the current year. Guys, you're obviously not going to calculate the finance cost using the closing balance at the end of the year. You're not going to say 80,000 Rand multiplied by the interest rate to get the finance cost for this year. The finance cost for this year will be based on the opening balance. So whatever's outstanding at the end of the previous period, you'll pay finance costs on this year. In the following year, you'll pay finance costs on the 80,000 Rand that's outstanding. All right, so that's the logic behind using the balance at the end of the previous period or the opening balance at the beginning of the period. Your finance costs in this year will be calculated based on that opening balance over there. So you can see that discussion just below. Finance costs in the current year will be calculated using the opening balance of interest-bearing debt, or in other words, the closing balance at the end of the previous period. Now please note there is an alternative. Instead of using the closing balance at the end of the previous period, you can calculate an average. And we calculate an average by taking the opening balance, adding the closing balance, and dividing by 2. Now, when would this alternative be appropriate? If the company is only making payments on this loan on an annual basis, so for example, at the end of every year, they are repaying 20,000 Rand on this loan. They are only making payments once a year. Then it makes more sense to use the opening balance over here or the closing balance at the end of the previous period to perform the calculation. However, if this loan is repayable more regularly, so let's say, for example, let's change this over here. So at the beginning of the year, 100,000 Rand is outstanding, but the company repays 20,000 Rand at one point in the year, another 20,000 Rand at another point in the year, and another 20,000 at the end of the year. So they've made 3 repayments this year. So at the end of the year, we've got 40,000 Rand outstanding on this loan. Now, guys, it doesn't make sense if we are trying to calculate the interest expense or the finance cost for this year. It doesn't make sense to use the opening balance because every time the company makes a payment, the interest expense is going to drop. So after this point, the interest will be based on 80,000 Rand. At this point, interest will be based on 60,000 Rand. So now it makes sense to rather use an average. And you calculate the average by taking the opening balance, adding the closing balance, and dividing by 2. So you would say 100,000 Rand plus 40,000 Rand divided by 2 gives me 70,000 Rand. And you would use an average. So it makes sense to use the opening balance at the beginning of the year or the closing balance at the end of the previous period if there's only one payment per annum. However, if there's more than one payment per annum, then it makes more sense to calculate an average and use the average. So just make sure you understand the logic behind that, please, guys, because if you understand the logic, then you won't make the mistake of using the closing balance at the end of the year. It makes no sense to ever use the closing balance at the end of the year. Now, please note once again, guys, we can't perform this calculation for our lecture example. We do have finance costs on the statement of comprehensive income, but we don't have the interest-bearing debt at the end of the previous period. We don't even have interest-bearing debt at the end of the current period. We don't have that information. So we can't perform this calculation, but please make sure, study the formula, make sure that you can perform the calculation. Then, guys, when it comes to the discussion of this ratio, you should benchmark to the prime lending rate, because whatever interest rate the company is paying, it should be closely linked to the prime lending rate. If it's much higher than the prime lending rate, then it indicates a potential problem, and you can see that just below. A high effective interest rate indicates high financial risk. Remember, guys, interest and capital repayments on debt must be made regardless of financial performance. So even if a company has a bad year, they still have to pay the interest and capital on debt. So this exposes the company to financial risk. So if a company has a lot of debt in its capital structure, the debt providers will be exposed to more risk, because there's a risk that the company won't be able to meet the interest and capital repayments. And because the debt provider is exposed to more risk, remember the relationship between risk and return, they are going to charge a higher rate of interest to compensate them for this risk. So if you've calculated an answer over here, let's say of 15%, but let's say, for example, the prime lending rate is 10%, you can see the company is being charged a much higher rate of interest than the prime lending rate. And the reason for that might be that they have too much debt in their capital structure. As a result of that, the debt provider is exposed to high levels of risk. They want to be compensated for that risk, so they are charging a higher interest rate. All right, just make sure you understand the logic over there. Right, then the next ratio is earnings per share. And I've got the interpretation here for you again. This ratio indicates the profits that are available for distribution to shareholders. So it's not what's actually distributed, that would be the dividend per share, but this is the profit that is available for distribution. And we calculate earnings per share by taking the profit attributable to equity holders and dividing by the weighted average number of ordinary shares. All right, and we can perform this calculation in our example because we do have enough information. Here's the profit for the year. So for each year, you're going to take the profit and you're going to divide by the number of shares in issue. They have 100,000 shares in issue. So simple calculation. Sorry guys, lots of scrolling here to get to all of the different calculations. I hope you're not getting dizzy. Here we go, there's the calculation. All right, and then please just note, guys, when it comes to earnings per share calculations or dividend per share calculations, you always show this as cents per share. So don't show your answer in rands, you show your answer in cents. So that's why I'm multiplying by 100 over here so that I can convert the answer from rands into cents. So you just take the net profit and you divide by the number of shares in issue, multiply by 100 so that you can get the earnings per share in cents. So let's just add that to your lecture notes. You want this to be an answer in cents, so you just need to multiply by 100 to convert that into cents. Then next, guys, you need to be able to calculate headline earnings per share. And headline earnings excludes asset sales, termination of discontinued operations, restructuring changes, and write-downs. So as a result of this, headline earnings indicates profits generated from an entity's core business activities. And this is useful when we are trying to compare the results of core business operations of similar businesses within the same industry. All right, and when performing this calculation, you now just use headline earnings and you divide by the weighted average number of ordinary shares in issue. Please note, guys, if insufficient information is provided, you should just calculate earnings per share. So in our lecture example, we can't calculate headline earnings, so we will just calculate earnings per share. Then, to wrap up profitability ratios, please note that the following ratios, which can be found under the heading Return on Invested Capital, can also be classified as profitability ratios. So if the required is open-ended and it says analyze profitability, these ratios should also be calculated if there are enough marks available. So you can calculate return on assets, return on equity, return on capital employed. All of the calculations can be found under the category return on invested capital ratios. So we'll look at them when we get to return on invested capital ratios. So you can see that just below here. If you are tested on profitability ratios only, you should also calculate these ratios. All right, obviously, depending on the marks available. At the start of the lecture, I told you use the mark allocation as a guideline so that you know how many ratios to calculate. Guys, if there's only 5 marks available for ratio calculations, you're obviously not going to calculate return on assets, return on equity, return on capital employed, because you can get those 5 marks a lot easier by rather looking at all of the previous ratio calculations. And remember, all of these ratios are listed in the order of importance. So when you start with your calculations, you start at the top and you work your way down. So if you've already performed enough calculations based on the marks available, you stop and you don't continue just performing calculations. Obviously, then you're just wasting time. All right, guys, so that deals with everything in the lecture notes. Let's just go back to the lecture example and make sure that we have performed all necessary calculations. Please note, like I said, you must let the information provided in the question guide you. Wherever you are given industry averages, guys, this is going to be used for benchmarking purposes when it comes to our discussion. So if you have been provided with industry averages, you must definitely perform the same calculations for this company, for Camille Limited. So we did calculate the change in revenue, the gross profit margin, the operating profit margin, the net profit margin. However, we have not calculated the change in earnings per share. So let's just quickly calculate the change in earnings per share, and then we've performed all calculations for this lecture example, and we'll then come to our discussion. All right, so that's just that one last calculation over there. All right, so here's the change in earnings per share. So remember, guys, whenever you're calculating a movement or a change, you take the current year, you subtract the prior year, and you divide by the prior year. So there's the current year earnings per share, there's the prior year earnings per share. You can easily perform the calculation. We have a decrease of 25.74%. All right, guys, so that deals with all of the calculations for this lecture example.